In this video, we're continuing on with Managerial Accounting, Chapter 4, Cost, Volume, Profit Analysis. This is truly one of my favorite topics in Managerial Accounting. We've got only 6 learning objectives here, and I'll start with Learning Objective 1. Calculate the unit contribution margin and the contribution margin ratio. Now, we've already done the contribution margin income statement, so this is just expanding on that. CVP is a powerful tool that helps managers make decisions using the relationships between costs, volume, and the company's profit. For example, what would happen to our operating income if transportation costs to bring in materials increases by 20%? Companies can use CVP analysis to figure out the sales volume that will be needed to break even or cover fixed costs. They also use CVP analysis to determine the sales volume that would be needed to earn a target profit. For example, $50,000 every quarter. Let's look at an example. Say you're throwing a student party. The college has offered the student lounge for free. The DJ is going to cost $1,000 for one night. We know that that's a fixed cost because it doesn't matter how many people are coming. You'll be providing snacks and soft drinks, and that's going to cost $5 per person. You're going to charge everybody $10 to attend. How many tickets do you need to sell in order to break even? How many people have to purchase tickets in order for you to cover the cost of the DJ and the snacks? The sales revenue per person, less the variable cost per person, which is the cost of the snacks, is equal to the contribution margin, the amount per person that will contribute to covering the DJ costs, the fixed costs. So the ticket price per person is $10 and the snacks are $5, so the contribution margin per person is $5. To break even, meaning the profit is 0, you take the total fixed costs and divide it by the contribution margin per person. So that's 1,000 divided by $5. So you have to sell tickets to 200 people in order to break even. That's the break-even formula. Break even is equal to fixed costs, FC, divided by the contribution margin per person in this case, or per unit in all cases. The contribution margin per unit is equal to the selling price per unit less the variable costs per unit. Okay, so what data do we need in order to perform CVP analysis? Well, you need the sales price per unit, the number of units, the variable cost per unit, the total fixed cost, and the profit or loss. Actually, you only need 4 of these 5 pieces of information. If you have 4, you can calculate the 5th one, the unknown number. Now, what assumptions do we make about CVP analysis? First, that the change in the level of activity is the only thing that affects costs. We know that's not actually true in real life. Multiple things can affect costs, such as changes in demand. But we assume that only volume changes cost. Otherwise, costs are constant. We also assume that we can classify all costs as either variable or fixed, and that they're linear through the relevant range. Again, we know that this is not true in real life because costs can be mixed in a way that is not easy to tease apart. But again, to allow CVP analysis to work, we assume that all costs can be categorized into variable or fixed, and both of them are linear. We assume that revenues are linear, meaning that the selling price per unit does not change in the relevant range. Now, in real life, revenues per unit may change. We could have a sale or we could have a discount to match a competitor's price. But for CVP analysis, we assume this does not happen. We also assume that inventory levels will not change, that there will always be the same amount of inventory on hand. And finally, we assume that the sales mix of products does not change. This means that if, for instance, we sell 2 replacement blades for every lawn mower sold, this will always stay the same. Note that we make these assumptions because it would be difficult to perform CVP analysis otherwise. All right, Let's look at an example on Excel. Kay has an e-tail poster business. She currently sells each poster for $35, while each poster has a variable cost of $21. Kay has fixed costs of $7,000. Kay is currently selling 550 posters. Kay's relevant range is 0 to 2,000 posters. 1. Create a contribution margin income statement for Kay's business. Well, we can do that pretty quickly. So we're going to start with the name. And this is the contribution margin income statement. And let's just assume it's for the month ended January 1st, 2000X1. We're going to start with sales revenue. We know that Kay sells 550 posters and she sells them for $35 each, so that is $19,250. We know that the variable costs are $21 per unit multiplied by 550 posters. Subtract these two numbers and we get the contribution margin. Now we need to subtract the fixed costs, and that's $7,000. So Kay's operating income is going to be the $7,700 minus the $7,000. So her operating income is $700 at the end of January. 2. What is the selling price per unit, the variable cost per unit, and the contribution margin per unit? Well, we can calculate that pretty easily. If we put the number of units up here, which is 550, I can take the sales revenue and divide it by the number of units. 35. Variable cost divided by the number of units. 21. Contribution margin divided by the number of units. 14. I'm just showing you how I could calculate it if you were given a contribution margin income statement and not these individual amounts. 3. What is the contribution margin for 650 units? Do we have to do a whole contribution margin income statement again? And the answer would be no. If we want the contribution margin, the total contribution margin for 650 units, we would take the per unit contribution margin, multiply it by 650 units, and that would immediately tell us that if Kay sold 650 units, she would make $9,100 of contribution margin. If we subtract the $7,000, just like we did previously, it would show us what our operating income is going to be. And in this case, the operating income would increase to $2,100. What does this tell us? It tells us that when we have a contribution margin above the fixed costs, every penny of the contribution margin per unit ends up as part of the operating income. Why? Because we've already finished covering the fixed costs. Because the fixed costs are covered, every penny of additional contribution margin hits our bottom line. 4. What is the contribution margin ratio? What is the variable cost ratio? Well, let's calculate them. I'm just going to copy this down. There we go. And I'm going to move this over. All right. This is the total. This is per unit. And I'm just going to put some lines in here so we know what's going on. There we go. So what's the contribution margin ratio? The ratio is calculated as contribution margin divided by sales revenue. And I'm going to change that into a percentage. It's 40%. That's the contribution margin ratio. So for every dollar of sales revenue that we sell, 40% of that dollar ends up being our contribution margin. We can also calculate the sales revenue ratio. That's sales revenue divided by sales revenue, and it's going to be, of course, 100%. Now, what about the variable cost ratio? We're going to take the total variable costs and we're going to divide them by the sales revenue, and guess what? It's 60%. This makes total sense. 100% minus 60% is going to be equal to 40%. So what does that mean? I can give you one of these, the variable cost ratio or the contribution margin ratio, and you should be able to calculate the other one because the sales revenue ratio is always 100%. So for instance, if I told you that the variable cost ratio was 35%, then you should immediately be able to tell me that the contribution margin ratio, well, let's just do that. If I say that this is 35%, this is 65%. The contribution margin ratio would be 65%. Let's get rid of that. Now, I calculated the contribution margin ratio and the variable cost ratio using the total. What if I used the per unit? What would happen? Well, we would end up with the exact same answers. It doesn't matter if we're calculating the contribution margin ratio and the variable cost ratio using the per unit or the total, the results are exactly the same. 5. Assume K generates $70,000 in sales revenue in 1 month. How can you use the contribution margin ratio to determine her operating income? Well, I'm going to move this down for a second, just so we can see the calculations. If I know that the sales revenue is going to be $70,000, I know this is 100%. I know that the contribution margin is going to be 40%. So I can take that $70,000 multiplied by the 40%, and that's my contribution margin, right? This is my sales revenue. So I can use my contribution margin ratio to calculate what the contribution margin is going to be. If I take that contribution margin and I subtract the fixed costs, which we know are $7,000, then I know my operating income is going to be $21,000. Verify this estimate by producing K's contribution margin income statement. So I'm going to take this income statement, I'm going to copy it down so I don't have to type it all out again. So sales revenue we know is going to be $70,000. We know the contribution margin is going to be $28,000. So therefore we can calculate the variable costs. It's going to be $70,000 minus the contribution margin, which is equal to $42,000. We know the fixed costs are going to be $7,000. So therefore, we can see that the operating income is going to be $21,000, exactly what we said it was going to be over here. Let's move on to learning objective 2. Use CDP analysis to find break-even points and target profit volumes. All right, what is the break-even point? This is where we have a sales level which results in an operating income which is 0. That makes sense. We're breaking even, meaning we're making nothing. If sales are higher than the break-even point, we're going to make a profit. And if sales are below the break-even point, we're going to lose money. It also is the point where fixed costs are equal to the total contribution margin. Well, that makes sense. Total contribution margin minus fixed costs have to be 0, so the two of them have to be equal to each other. And total sales is equal to total expenses. Makes sense too. Total sales minus total expenses is going to be equal to 0. Now, there's 3 ways we can calculate the break-even point. Again, remember that operating income at this point will be 0. 1, we can use the income statement approach. This is where we plug operating income as 0. We know the fixed expenses, we know the variable cost per unit, and we know the sales price per unit. What we are solving for is the unknown number, which is the units sold. That's the income statement approach. We can also use the shortcut approach. So we take the unit contribution margin, in dollars, and we use it to calculate the break-even in units. Sales in units is equal to, this is the unknown, fixed expenses in total. Any operating income that we want to earn, and of course if it's break-even, our operating income is going to be 0, and we divide it by the contribution margin per unit. So this is a dollar value here. So that's method 2. Method 3 is called the shortcut approach using the contribution margin ratio. In this case, we don't determine units. It determines sales in dollars. So sales in dollars, this is what we want, is equal to the total fixed expenses plus whatever operating income we want to earn. And of course, if it's break even, our operating income is going to be 0, divided by the contribution margin ratio. All right, let's look at Excel so we can practice this. Now, we still have Kay with her e-business. She sells the posters for $35, variable cost $21, fixed costs are $7,000. Calculate the break-even using the income statement approach. Well, we already know what the income statement approach is. There we go. We've got sales revenue, selling price. Well, we know that this is $35, and the selling price is multiplied by some number X. And then we're going to subtract the variable expenses per unit, so we know that this is $21, and that is multiplied also by X. Then we're going to deduct the fixed cost, which we know, by the way, is $7,000. This has to be equal to 0, because that's break even. So we have our formula here, and we're just going to solve for the unknown number. So $35 minus the $21 is equal to 14x. We're also going to subtract that $7,000 right here. And that's going to be equal to our 0 operating income. 14x is going to be equal to positive $7,000. X is going to be equal to 7,000 divided by 14. X is equal to 500. So we know we have to sell 500 units in order to break even. At that point, remember that Kay's business is going to be making nothing. That's the income statement approach. 2, calculate break even using the shortcut approach, unit contribution margin. So let's go down, remind ourselves what that is. For the shortcut approach, we're calculating sales in units, and we're doing it by taking the fixed expenses plus the operating income. At break even, it's equal to 0, divided by the contribution margin per unit. We can remember the contribution margin from the previous. We know the contribution margin per unit is $14. It's got to be dollars, not the percentage. We want the dollars. $14. Just 1 minute. I'm going to move down. So X is going to be equal to the fixed expenses, which we know are $7,000, add in the operating income that we want, which is 0, and we're going to divide all of this by the contribution margin per unit, which we know is $14. I can also calculate this. Maybe I should do that. So calculating it, it is the $35 minus the $21, $14. So we're just going to do this calculation. We know that X is going to be equal to 7,000, I don't have to add in the 0, divided by 14. Guess what? It's 500 units. We already knew that, but we're using a different way to calculate it. This way is a lot faster. 3, calculate break even in sales dollars using the contribution margin ratio. So let's move down, give ourselves some space. Keep in mind that this calculates the required break even in sales dollars. So how many dollars do we have to sell to end up with an operating income of 0? So in this case, I'm not calculating X. I'm actually calculating some other factor, which let's just call S. So S is going to be equal to the fixed expenses, 7,000, add in the operating income for break even, 0, and then divide it all by the contribution margin ratio. We know what that is. We've already done it. It is 40%. So we know it's 40%. We're going to use it over here. We could always calculate it. So looking at this is going to be equal to the $35 minus the $21 divided by the $35. 40%. What is that sales dollars that we need in order to break even? It's going to be that 7,000 divided by the 40%, and that is $17,500. That's what it is in dollars. Now, can we check that? Sure. We can take the 500 units break even and multiply it by the $35 per unit, and I bet you it's going to be $17,500, and it is. So we know that this is the break even in sales dollars. We've calculated the break even point where the operating income is zero, but no company wants to earn zero profit. So how many units do we have to sell in order to make a target profit? We want a specific amount of profit. How much do I have to sell? So CVP analysis will help us to determine what we need to sell in order to earn a target amount of profit. It'll tell us, hey, you need to sell these many units or you need to sell this much in sales dollars. So let's look at Excel. We still have Kay with her e-tail business. She's selling the posters for $35 and each poster has a variable cost of $21. She has fixed costs of $7,000. If Kay wants to earn $4,900 of operating income, how many units would she have to sell? Use the contribution margin to calculate your answer. This is the contribution margin per unit. The shortcut, let's just pop back here. We're going to look at that shortcut. Here's this shortcut. We're going to copy it. We're going to plug it into, there we go. All right. So we've got that X units that we have to sell. And we're going to take the fixed expenses, 7,000, and we're going to add in the operating income that we want. And we want $4,900 of operating income. We're going to divide that by the contribution margin per unit. We already know that this is $35 minus the $21, which is $14. We simply have to do the division here. So X is going to equal the 7,000 plus the 4,900 divided by the 14. And so X here is going to be equal to how many units? 850 units. So we have to sell 850 units in order to earn $4,900 of operating income. So it's pretty easy. It's the same formula. We're just changing the operating income from being zero to being some number. So if Kay wishes to earn $4,900 of operating income, how many units? I put that wrong. How many sales dollars would she have to sell? I'm going to use the shortcut approach. So I'm going to go back over here. Here we go. I'm going to copy that. And I'm going to plunk it here. There we go. We're calculating the sales in dollars. That's going to be equal to the fixed expenses, 7,000, plus the operating income we want, 4,900. But this time, we're going to divide it by the contribution margin ratio. Remember that ratio? We have it right here, 40%. So we're going to take that 40%. And I'm going to divide all of this. And so let's figure out what S is going to be. 7,000 plus the 4,900 divided by the 40. I'm going to put the line where it belongs. And the fact is, sales are going to be equal to $29,750. Is this true? Well, we can see. We can take that 850 units, multiply it by $35, $29,750. So yes, it works perfectly. All right, so we know about this target income, but what would it look like if we graphed CVP? If we create a CVP graph, we can see that the total revenue line, which is here in red, and the total expense line, which is right here in blue. And notice the intercept is at the 7,000, which is the fixed cost. So you can see that fixed cost is straight. So we can see that break even is where the total cost line and the total revenue line intersect. That makes sense. This is the break even in sales dollars, 17,500. We calculated that. This is the break even in units, 500 units. We calculated that. Anything below this line, the area in here, that's how much money we're losing. Anything above this line right here, that's where we're making money. So looking at 1,000 units right here, we know that when we sell 1,000 units, we're going to use some of that revenue. $7,000 of that revenue is going to be covering the fixed expenses. Then this amount right here, between the fixed cost line and the total cost line, that's covering the variable expenses. And this area right here, that's our profit. So you can see 28,000 right over here and 35,000. This, between these two numbers, that's how much we are earning in revenue. So we are earning a total of $7,000 in revenue at this point, 1,000 units. This is how much our sales revenue is going to be. This is how much our total costs are. So you can see that if we're in this space above the break-even point, we are laughing. We're down here. No, not good. Okay, let's do a quick check of your understanding. When a company is operating at its break-even point, A, its selling price is equal to its variable expense per unit. B, its contribution margin is equal to its variable expenses. C, its fixed expenses are equal to its variable expenses. Or D, its total revenue is equal to its total expenses. And the answer is D. That's because the total revenue minus the total expenses has to be equal to 0 at break even because we're not generating any profit. If a company sells 1 unit above its break-even sales volume, then its operating income would be equal to A, the unit selling price, B, the unit contribution margin, C, the fixed expenses, or D, 0. And the answer is the unit contribution margin. As soon as we reach break-even sales, we know that the profit is equal to 0. Every unit we sell after that, we've already covered the fixed expenses, so the contribution margin per unit is going to add directly to the bottom line. How do we calculate the sales necessary to reach a target profit? A, target profit divided by unit contribution margin. B, target profit divided by unit contribution margin ratio. C, fixed expenses plus How do we calculate the sales necessary to reach a target profit? A, target profit divided by unit contribution margin. B, target profit divided by unit contribution margin ratio. C, bracket, fixed expenses plus target profit, bracket, divided by unit contribution margin. D, bracket, fixed expenses plus target profit, bracket, divided by unit contribution margin ratio. And the answer is D. Bracket, fixed expenses plus target profit, close bracket, divided by unit contribution margin ratio. Remember, it said, how do we calculate the sales necessary to reach the target profit? And sales is calculated using the unit contribution margin ratio. The number of units to be sold to reach a certain target profit is calculated as A, target profit divided by unit contribution margin, B, target profit divided by unit contribution margin ratio, C, bracket, fixed expenses plus target profit, close brackets, divided by unit contribution margin, and D, bracket, fixed expenses plus target profit, close bracket, divided by unit contribution margin ratio, and we already know the answer to this is going to be C. It's going to be divided by the unit contribution margin per unit contribution margin, dollar value. That calculates the number of units to be sold to make a target profit. All right, let's move on to objective 3, perform sensitivity analysis in response to changing business conditions. We know that managers have to be prepared for things to change. We're going to have changing costs. We're going to have pricing changes. We're going to have changes to the business condition. So, sensitivity analysis. This is when we ask what if questions. Here's the existing scenario. Now, what if fixed costs change? What if the variable costs change? What if the sales mix changes? What if the selling price changes? What if? We use sensitivity analysis to determine that no matter what happens in the future, we're prepared because we have an idea what will happen. So let's do a bit of sensitivity analysis. We're back at Kay's e-poster business. Everything's the same. $35 selling price, $21 variable cost, $7,000. We currently sell 5,500 posters. 1. Kay has determined that if she runs an advertising campaign that costs $1,000, the sales will increase to 600 posters from the 550 posters. Should she run the campaign? Well, we know that what she's going to earn extra is the contribution margin. And we know the contribution margin is equal to the $35 minus the $21 variable cost. That's $14. She's going to sell an additional 50 units. So what is she going to earn from these additional sales? Well, she's going to earn $700, but it's going to cost her $1,000 to earn that $700. Guess what? Kay's operating income will reduce by $300 if she decides to move forward with it. She's going to earn an additional $700, but it's going to cost her $1,000 to do so. So, hey, should she run this campaign? Absolutely not. 2. Kay's supplier has increased the price of each poster to $23.80 instead of $21. Kay plans to hold her selling price steady at $35 because of the competition. How many units must Kay sell to break even now? Well, we can calculate this. We know that X is going to be equal to the fixed costs, $7,000, that doesn't change. And we've got to add in the operating income that we want to earn, break even, that's going to be 0. We're going to divide it by the contribution margin per unit. And we know that that is changing. She's keeping her price at $35, but guess what? Her variable costs are now $23.80. So she's only going to be earning $11.20. Wait 1 second. I'm just going to center all this. All right. So how many units does she have to sell now in order to break even? Before it was 500. What's it going to be now? Well, we can calculate it. 7,000. Don't have to add in the 0. Divided by 1120. She has to sell 625 units in order to break even because of the higher variable costs. CVP analysis ties into sustainability. How? We know that if we save anything on the variable costs, we're going to improve the contribution margin, and we might be able to increase sustainability at the same time. When we do research in order to reduce variable costs, yes, there'll be costs involved in that research, and we might have additional fixed costs associated with any changes that we do in the design or the manufacturing process. So it's going to consume some of the contribution margin that we're saving, but in the long run, the business would benefit by becoming more profitable and more sustainable. What's an example? Coca-Cola. So they were trying to reduce their materials and their greenhouse gases. So what they did is they reduced the amount of plastic in their bottles and in their caps. So they're reducing plastic waste, but they're also reducing the amount of materials they were using. Their ultra glass contour bottles are stronger, they're lighter, and they were cheaper to produce than their original design. So although they had to make a really large investment in research and doing design changes, purchasing new machinery, in the end, they increased their contribution margin to cover all those costs and improve their profitability while at the same time reducing garbage. Now, let's do a quick check of your understanding. The break-even point on a CVP graph is A, the intersection of the sales revenue line and the total expense line. B, the intersection of the fixed expense line and the total expense line. C, the intersection of the fixed expense line and the sales revenue line. And D, the intersection of the sales revenue line and the y-axis. And the answer is the intersection of the sales revenue line and the total expense line. If you look at a CVP graph, you'll see why. If the sales price of a product increases while everything else remains the same, what happens to the break-even point? So remember, sales price is increasing. The break-even point increases. The break-even point decreases. The break-even point remains the same. The effect cannot be determined without further information. And the answer is B, the break-even point decreases. Check it out. Here we've got the CVP graph. If we increase the selling price, the slope of the sales revenue line is steeper. So that's going to cause the intersect between the revenue line and the total cost line to move down. So the new break-even point, it's earlier. We're going to move the break-even point down. So we'll have fewer units, whatever they happen to be, and we'll have to earn less sales dollars in order to break even. 3. Target profit analysis is used to calculate the sales volume that is needed to A, cover all fixed expenses, B, cover all expenses, C, avoid a loss, D, earn a specific amount of net operating income. And the answer is D. Let's move on to objective 4. Find break-even and target profit volumes for multi-product companies. So what is a sales mix? Because we need to understand that for a multi-product company. And the official definition is the relative proportion or ratio of different products or services a company sells. But let's give an example. Glade plugins. If we sell one Glade plugin, then we sell 5 refills. That's the sales mix. One plugin for every 5 refills. So the sales mix is the ratio between different products that are interrelated. If I sell one Glade plugin, I sell 5 refills. So let's do a sales mix example because you need to understand this. Again, we're using Kate's e-tail poster business. She currently sells 2 kinds of posters. A regular poster for $35 with a variable cost of $21 and a large poster for $70 with variable cost of $40. Her sales mix is that she sells 5 regular posters for every 3 large posters, and her fixed costs are still $7,000. How many of each type of poster must she sell in order to break even? Calculate the number of units. So we're going to start with a calculation that's very similar to what we did previously when we were trying to calculate units. Our formula is going to be sales in total units. That's going to be equal to fixed costs in total plus our operating income. If we're calculating break-even, operating income would be 0, but if we're calculating our target income, it would be some number. And we're going to divide this all by the weighted average contribution margin per unit. And what we're going to do is I'm going to show you how to calculate that. So this is a little bit different. It's a little bit more challenging, but don't worry, it's just a process. And as long as you get the process down, you're going to be fine. So step 1 is always to calculate the weighted average contribution margin per unit. So how are we going to do that? We're going to start by having column for regular and for the large posters. We want the sales price per unit. And we know for regular it's 35 and for large it's 70. We're going to deduct the variable costs per unit. And I'm just going to move this over because I need extra space. So we're going to deduct the $21 here and for the regular, $40 for the large. This will give us our contribution margin per unit. So it's 14 for regular, we already knew that, and it's 30 for the large. Perfect. Now we're going to multiply this by the sales mix. So we know for regular, we're selling 5 regular for every 3 large. So we're going to put 5, and we're going to put 3 in here, and we're going to multiply that out, and that's going to be the contribution margin for the basket of goods. The basket as in 5 regular, 3 large. Just going to put a line so it clarifies everything. So if we sold 5 regular, we would make $70 in contribution margin. And if we sold 3 large, we would make $90 in contribution margin. So over here, we're going to do the total. And the total of these two added together is going to be $160. Now I'm going to total how many units are in there. How many units are in there are 8. If I then take the contribution margin of the basket of goods and I divide it by the number of units that are in the basket, in total, 8, this is giving me the weighted average contribution margin per unit in the basket. Remember, that is the $160 total contribution margin divided by the number of units that are in the basket. And that is equal to $20. $20 is our weighted average contribution margin per unit. So you got to think, if I want sales in total units, it's going to equal the fixed cost, 7,000, plus the operating income at break even, it's equal to 0, and it's going to be divided by the weighted average contribution margin per unit, 20. So that'll allow me to calculate the sales in total units. So that is 7,000 plus 0, which is equal to 7,000, divided by the $20, that is equal to, that's not dollars, 350. 350 what? 350 total posters. Total posters. That includes the regular and the large. So now I've got to take these total posters and I've got to divide them between the regular and the large. How do we do that? I'm going to use this ratio right here. So for the regular posters, I'm going to take the 350. I'm going to multiply it by the number of regular posters I sold, 5, and I'm going to divide it by the total 8. I'm going to put the division in here. There we go. 350 multiplied by 5 divided by 8 is equal to 218.75 regular posters. There we go. For the large, I'm going to take the 350 total posters. I'm going to multiply it by the 3, divide it by the 8. 3 is how many large posters there are. Doing that, 350 multiplied by 3 divided by 8. This is equal to 131.25 large posters. So now I know how many of each of these I have to sell. What would be my total revenue if I sold these? I would multiply it by the $35 for the regular and by the $70 for the large, and that would tell me I'm going to make $7,656.25 from the regular and I'm going to make $9,187.50 for the large, for a total revenue of $16,843.75. So this is the formula. The only thing we changed is we changed the denominator. And this is sales in total units. So I calculated the total units of all posters, and then I teased out the units for the regular and the units for the large. 2. How many of each type of poster must K sell in order to break even? Calculate break even in terms of sales revenue. So now I'm going to do it in terms of sales revenue. That's a little bit different. So that formula would look like this. Sales revenue in dollars is equal to fixed costs plus operating income, which we know is 0, divided by the weighted average contribution margin ratio. Well, we knew that was going to include a ratio because, of course, it included a ratio previously too. But I'm going to do the weighted average contribution margin ratio. First, I have to calculate that. How am I going to do that? I'm going to start again with 2 columns, one for regular and one for large. I'm going to do the sales revenue per unit. Regular, 35. Large, 70. I'm going to multiply it by the sales mix. So this was 5 and 3. Now, the total revenue in the basket is going to be $385. This is the total basket revenue. All right, putting lines under here so we remember this. Now, I also need the contribution margin, so I'm going to do the contribution margin per unit. I know what the contribution margin is here. It's 35 minus the 21. Contribution margin here is 70 minus the 40. I'm going to multiply this by the sales mix. So this is 5 and 3. Add them together. This is the total basket contribution margin. So remember, to calculate the contribution margin ratio, we take the contribution margin and divide it by the sales revenue. Contribution margin divided by the sales revenue. Percentage? I'm going to give it a few more decimal places. There we go. That's the weighted average contribution margin ratio. Exactly what we need. So we're going to calculate the sales revenue in dollars. We're going to take the fixed costs, $7,000. We're going to add in the operating income, 0, break even. We're going to divide it by the weighted average contribution margin ratio. Here we go. Center all of these. Perfect. Put a line underneath it. And so the sales revenue in dollars is going to be 7,000 plus 0, doesn't change it, divided by 41.56%. And this is equal to 16,000. I'm going to change it to $1. 16,844, which is rounded. What do you notice about this number? What you should notice is it's identical to the number we calculated up here. $16,843. $16,843.75 is identical. So for the sales revenue in dollars, we calculate the total Over here, for the units, we split it between the regular, this is 218.75 regular posters, and the large, 131.25 large posters. Keep in mind, we actually can't sell 0.75 poster, so we would round it up to 219 and round this down to 231. All right. That's how to calculate the units and the sales dollars for a multi-product company. Let's move on to learning objective 5. Determine the common indicators of risk for a firm, margin of safety, and operating leverage. So there are some common indicators of risk. And the company, their risk level really depends on a lot of factors. The economy, the industry they're in, what's happening globally. There's a lot of things that impact the risk that a company is subjected to. It really also depends on the current volume of sales and the relationship between the fixed costs and the variable costs that make up the total cost. There are two commonly used indicators of risk, and one is the margin of safety. Margin of safety is the excess of the actual or expected sales over the break-even sales. And the operating leverage is the other one. It's the relationship between the fixed and variable costs that make up the company's total costs. Let's look at margin of safety. Remember, excess of actual or expected sales over the break-even sales. This shows us how far sales can fall before the company starts incurring a loss. And we use it really to evaluate how risky the current operations are, as well as how risky maybe a new plan is into the future. It's calculated as the margin of safety in units is equal to the expected sales in units minus the break-even sales in units, but can also be calculated as the margin of safety in dollars, sales dollars, which is equal to the expected sales in dollars minus the break-even sales in dollars. Let's look at itself and do an example. So we've got Kay. She currently sells each poster for $35 and they have a cost of $21. She has fixed costs of $7,000. She is currently selling 950 posters. Calculate the margin of safety in units. Now, we happen to know what the break-even is. Remember, we calculated it back here. Break-even is 500 units. So we know that current sales in units minus break-even sales in units is going to be equal to the margin of safety. So current sales in units, 950, minus the break-even, 500. This is going to equal our margin of safety, 450 units. That's our margin of safety. Now, let's quickly go back to the graph so we can see what this means on the graph. If 500 is our break even, which we know it is, and I know it says 1,000 here, but let's assume it's 950, our sales would have to decline by 450 units before we were in loss territory. That's a really high level of loss, right? I mean, it's almost a 50% loss in the number of units we're selling. So we have a large margin of safety. I'm feeling very comfortable. If something untoward happens, we are fairly safe. Similarly, we can calculate the margin of safety in sales dollars. We know this would be equal to current sales in dollars minus the break-even sales in dollars, and that is equal to the margin of safety in dollars, just to be clear. So we know that the current sales in dollars are the 950 multiplied by the $35. So that is 33,250. We are going to subtract our break-even sales. We know what that is. We calculated it previously. I'm going to find it for a second. 17,500. This is going to be equal to what? 15,750. And this is all dollars. Again, when we look over here, this is break even. 33,250, probably right there, right? So again, we have a huge, huge drop that we can suffer before we end up in a loss position. So I'm feeling very safe and very confident right now. It says calculate the margin of safety percentage using both units and sales dollars. Are they different? So margin of safety percentage. How is it calculated? What's the formula? It's always the margin of safety divided by the current or expected sales. Just going to center this, and I'm going to put a line. There we go. So the margin of safety, doesn't matter if we're doing units or dollars, we're going to take the margin of safety, 450 units, and we're going to divide it by the current or expected sales, 950. And we can see that this is a percentage. It is 47, give it a few more decimal places, 47.35. Let's do it for sales. We're going to take the margin of safety, divide it by the current or expected sales, and guess what? Oh, that's dollars. We'll change it here, give it 2 more decimal places. They're identical. Now, how do we read this? The higher this percentage is, the safer we are. So we can decline our sales by 47% before we hit break even, and a little bit more than that before we start suffering losses. So the margin of safety percentage is telling us how safe we are. And the higher this percentage is, the safer we are. The lower it is, the more we are at risk of hitting the break even and then falling into an area where we're losing operating income. We're in a loss position. That's the margin of safety. It's just telling us how risky our business is. What is the risk that we start losing money? Let's move on to the operating leverage. So remember that the operating leverage refers to the relative amount of fixed and variable costs that make up total costs. That probably doesn't make sense, but let's just expand on that. It tells us how the company's operating income changes with a change in the volume of sales. It shows how responsive, so how closely the two are tied together. The lowest possible value for this factor is 1. So that would mean the company has no fixed costs whatsoever. So if you ended up with an operating leverage of 1, it's telling you that there are 100% variable costs, 0 fixed costs. The operating leverage factor is calculated as contribution margin divided by operating income. And that is total contribution margin divided by total operating income. And the factor at a given levels of sales, you've got to calculate it every time sales change. So you can't use the operating leverage factor at different levels of activity. No, you calculate it every single time your level of activity, the production, changes. It indicates the percentage change in the operating income that will happen from a 1% change in the volume. So it really tells us how responsive the company's operating income is to changes in volume. The larger this number is, the more responsive operating income is to changes in volume. So let's calculate it. We're back with Kay's e-tail business. Remember, she's selling the posters for $35, variable cost of $21. She has $7,000 in fixed costs, and she's selling 950 posters. Calculate the degree of operating leverage. In order to do that, we have to know what the contribution margin is, and we have to know what the operating income is. So we're going to do that very first. Total contribution margin is going to be, of course, the $35 minus the 21, which is the contribution margin, multiplied by the number of units, 950. This is going to equal the total contribution margin. There we go. So the total contribution margin is $13,300. We've got to deduct the fixed costs. $7,000. This will give us our operating income. Now remember, the degree of operating leverage, how is it calculated? Degree of operating leverage is equal to the total contribution margin divided by the total operating income. So over here, total contribution margin divided by the total operating income, I'm just going to divide them. Now that's not a dollar value. It's 2.11111. I'm going to round this. I'm going to go up here. I'm going to say round. And I'm going to do it to 2 decimal places. There we go. 2.11 is the degree of operating leverage, or the operating leverage factor. I don't care which one you call it. That's the operating leverage factor. How do we use it? I'm going to show you. 2, if sales increased by 10%, what would the operating income be? Use the DOL to calculate the operating income. So this would be the percentage change multiplied by the degree of operating leverage is equal to the change in operating income. So the percentage change, which is 10%, 0.1, multiplied by the degree in operating leverage, 2.11. I'm just going to center these. What does that equal? So this is an increase in operating income. So if I take the existing operating income at this level of activity, we know operating income is $6,300, and I multiply it by this, the operating income will increase by $1,329.30. So if I wanted to know what's my new operating income, this would be equal to the $6,300 plus the increase, which would be equal to $7,629.30. So remember, the percentage change multiplied by the DOL is equal to the change in the OI. That's the percentage change in the operating income. I have to take the existing operating income, multiply it by the percentage change to show the actual dollar increase. And if I want the new operating income, I take the original and add in the dollar increase. And that will give me the exact amount of my operating income if there was a 10% change in the sales revenue. Let's go on to 3. If sales decreased by 5%, what would the operating income be? Use the DOL to calculate it. So remember, we said the percentage change, negative 0.05. Multiply it by the degree of operating leverage. This is a decrease, percentage decrease in operating income. I'm going to take the original operating income. I'm going to multiply it by what we calculated. And remember, this is the percentage decrease in the OI. It's going to decrease by $664.65. To calculate the new operating income, I have to take the old operating income and I have to add in this negative number. And that is going to equal $5,635.35. This requires practice. Now, let's look at the characteristics of a high operating leverage. If we have a high operating leverage, these companies have higher levels of fixed costs and lower levels of variable costs. They also have higher contribution margin ratios. For high operating leverage companies, changes in the level of activity will significantly impact operating income. So they have higher risk. Now, higher risk of losses, but higher potential for rewards also. Examples would be golf courses, hotels, rental car agencies, theme parks, airlines, cruise lines. Any business which has high fixed costs, they're going to be in a high operating leverage position. Small changes in their sales volume are going to cause larger changes in their operating income. Now, what about low operating leverage companies? Well, these guys have higher variable costs and lower fixed costs. They also have lower contribution margin ratios. For them, changes in the volume of sales, they don't have a huge impact on operating income. They have lower risk, and true, they have lower rewards, but it's important to recognize they have lower risk. And two examples of this are merchandising companies and fast food restaurants. Now, let's do a quick check of your understanding. A shift in sales mix from a product with a high contribution margin ratio towards a product with a low contribution margin ratio will cause the break-even point to A, increase, B, decrease, C, remain the same, D, increase or decrease, but the direction of change cannot be determined from the information given. And the answer is increase. Of course, because if we have a low contribution margin ratio, then we're going to have to sell a lot more products to cover the fixed costs before we're in a profit position. So it's going to cause the break-even point to increase. If the operating leverage factor is 3, then a 2% change in the number of units sold should result in a 6% change in sales, variable cost, unit contribution margin, or operating income. And the answer is operating income. Remember, the operating leverage factor, or the degree of operating leverage, tells us if there's a change in sales, what will be the change in operating income? What is the margin of safety? A, the amount of fixed and variable costs that make up a company's total costs. B, the difference between the sales price per unit and the variable cost per unit. C, the excess of expected sales over break-even sales. And D, the sales level at which operating income is 0. And we know the only correct answer here is the excess of expected sales over break-even sales. Let's do the last learning objective. 6, analyze cost, volume, and profit using data analytics tools. And to do that, we need to switch over to Excel. All right, we have Kay, and she has her usual business. She's selling the posters for $35, 21 variable cost, 7,000 fixed, and she's currently selling 9,500 posters. In order to use data analytics, we have to start with the information. We've got the sales per unit, and we know that that is $35. We've got less variable costs, and we know that is $21. This will give us the contribution margin per unit. $14. Just going to put a line here. Perfect. We know that the current volume is 950 units. this will tell us the total contribution margin. The 14 contribution margin per unit multiplied by the 950 units. If we deduct the fixed costs, which we know, 7,000. So we subtract them. I'm going to put a line under here so we know. And this is our operating income. Perfect. We know that K wants a target operating income of 4,900. That's the minimum that she wants. We're going to deduct $1. So this is our target. Now, you're probably wondering, why is she deducting $1? Because we're going to use some conditional formatting, and it'll identify figures that are greater than the target profit. And so if we put it at 4,900, it's going to highlight items that are 4,901. So we have to take away 1 so that it'll highlight everything that is 4,900 and higher. So that's why we deduct the 1. Now what we're going to do is what's called a what-if analysis. And we're going to create a data table using a what-if analysis. So we're going to start by putting in a value right here. And that value is going to be equal to our operating income. This is going to be the upper left-hand corner of our data table. Now going across the row of this corner cell, whichever one we chose, we're going to put in the possible sales prices because Kay is thinking of reducing her sales price, and we want to see what would happen if she reduced the sales price. So let's say she reduces the sales price to $29. And then what we're going to do is I'm going to take that 29 and I'm going to add in $1. So she might reduce it to 29, 30. I'm going to go across and I'm going to say, what if she increases them? So let's go across to, 39. These are all dollars. So I'm going to put them in as dollars. There we go. Now below this $6,300, going down the column of this corner cell, we're going to list the possible volumes that Kay would like to see in the data table. She's currently selling 950, but let's say she wants to know how bad it could be if she went down to 250. So I'm going to start with 1,400 units, and then I'm going to reduce this by 50 each time. I don't have to use 50. I could use 1 if I wanted to, but that would make too large a table. So I'm going to go down to 250. A little bit lower. That's 300. There we go, 250. So remember, this is the volume, this is the sales price. And we're saying, what if we sold at this volume at this sales price? Or at this volume at that sales price? That's what we're doing with our what-if analysis. Now what we want to do is we want to highlight all of this to the $39 and all the way down to the 250. Then I'm going to click on the Data tab. Right up here, Data. And I'm going to click on the what-if analysis. Right here. See that? It's got a little question mark. What-if analysis. Click on it. And I'm going to want a data table. So I'm clicking on the data table. You can see it's opening a dialog box. Now it's asking me for the row input cell. That row input cell is the sales. So I'm going to choose my original, which is 35. And then enter. I want the column input cell. And the column input cell, of course, is the volume, 950. So I've got the volume right here. I'm going to click it, and then I'm going to hit enter. And then I'm going to hit OK. you can see a complete data table. Now, you'll notice it's not actually showing dollars, but these are all dollars. So I'm going to change it to dollars. And I'm going to get rid of there we go. So at $29, 1,400 units, we're going to make $4,200. If we sell them for 30, we're going to make $5,600. 31, $7,000. So you can see it's telling us what would happen if I sell 1,200 units and I sell them at $35 each, I'm going to make $9,800. Now, what if I want to know when I make my target income of $4,900 or above? I'm going to use conditional formatting. So I'm going to select the entire table. Notice I'm not including the volume or the sales price, only the outcomes. I'm going to go in my Home tab and I'm going to click on Conditional Formatting. Then highlight Cell Rules, and then I want greater than. And that greater than is going to be my 4,899. I can choose what color I do it in. So I'm going to do green, filled with dark green, and I'm going to say OK. So notice that I am going to reach above my target operating income in all of these scenarios. In the remainder of the scenarios, I'm not going to reach my target income. Now, how can I use this? Well, let's say our fixed costs change and they go to $9,000. Wow. I am not going to make my target income unless I charge over $31 and 1,400 units. Did you notice how that changed? Let's go back. I have far more restricted ability to make my target income if my fixed costs increase. Now, what if my variable costs change? What if my variable costs went down to $19? Ooh, I'm in good shape if it goes down to $19. So I can change the variable cost per unit, the fixed costs, or I can change my target. So I change my target for 3,500. So every time I change one of these three, not the volume, nothing else, it is the variable cost, the total fixed cost, or my target operating income. It will update my what if scenario to show me under what scenarios I'm actually going to make the target income that I want to make. That's it for Chapter 4, Cost Volume Profit Analysis.